So I wanted actually to close with a kind of a case study, and way back in 2008, roughly around October, November, at the time of the financial crisis, I wrote a newsletter called How Bad Is It? It's about investing during the Depression, because I wanted to get a sense of how far was this crisis in 2008 going to run, and how would it compare? How would you create a portfolio that would would protect you and insure against loss in an extraordinarily challenging environment? So I couldn't think of a more challenging environment than the Depression. And during that time frame, Warren Buffett said the following. He said, investors should try to be fearful when others are greedy, and greedy when others are fearful. And this is right after he'd invested $10 billion in GE Capital and Goldman Sachs. When no bank was able to do this, he got a 10% preferred return plus upside if the share values of those companies would rise, which of course they did. So he's a perfect example of being a contrarian investment. So what about depression investing? Well, the headlines back in 1929 when the Depression started and the markets panicked were really awful. The real question is, how awful was that period of time, that decade? So the stock market dropped 83%. Dividends were cut 50% over a 4-year period of time. It took 26 years for the stock market to get back to where it was in 1929. The unemployment rate was 25%. Thousands of banks failed, and they weren't insured. There was no Social Security. There was no CPP. There was no unemployment insurance. Prices dropped 25%, and GDP dropped 33%. 2008 pales in comparison to what happened during the 30s. So we're going to look at an environment in the 30s and say, okay, let's see what kind of portfolio would function in that environment. So first off, we need a couple that might have been around during that period of time. So I picked on a couple who are known as Jonathan and Martha Kent. You may recognize the name. And as you can see, they are farmers in Kansas. And one day they're near the house, they're fixing the car. They hear a loud bang in the backyard, in the back 40. And they run out to see what's happened. And sure enough, they find a spaceship and a little baby. And the really interesting thing about this baby is this baby can fly, and not only that, it came with its own Halloween costume as well. So they decided to call the baby Clark, and as you can appreciate, he was the alpha male of his preschool. He was a very accomplished young man. So I'm using a little literary license here because if you know anything about Superman, you probably, if you're a trivia expert, you know that the first edition of Superman didn't come out until 1938. So yes, I'm using a license to take it back to 1929. And the reason I know it was 1938 is I came to Canada in 1961 from England, and the first thing I wanted to do once I found out that Superman comics existed was buy them. I was addicted to these comics, Superman, Batman, Flash, all of them, Justice League of America. And so I was thrilled to buy them, had a paper, I could afford to buy them, and sure enough, 1 year later, the price went up from 10 cents to 12 cents. Now that doesn't sound like much, but that's a 20% increase. That was my first experience with inflation. I was 11. And basically I looked at this and said to myself, the price hasn't changed for 24 years. I come to Canada and the price goes up 20%. So there was a correlation there of some kind. I couldn't quite figure it out. And I thought about this issue and I thought, we assume, because of what our recent history is, that inflation is a necessary outcome, but it isn't. And in fact, through a large part of history, there have been long, long periods of time with no inflation. So just a reminder of our model. Our model typically involves earning cash flow from all our portfolios, from rents, from real estate, dividends and option income from equities, and interest and dividends from fixed income. We want all that cash flow to equal roughly 4 to 5% of the capital our clients have invested. And in a perfect world, when they retire, they never actually have to sell an underlying asset. The income from the portfolio meets all of their requirements. So let's kind of modify this because we don't have quite the same data going back to the 1930s we have going back 20 years. So we're going to build a portfolio with 1/3 in publicly traded stocks, 1/3 in corporate bonds, and 1/3 in real estate. And we're going to use the people history and a website called globalfinancialdata.com we use to actually get the historical returns for these asset classes. So let's take a look at what $100,000, roughly worth about $2 million today, would have done in 1929. Now remember, the market dropped 83% in 4 years. And we're going to adjust everything for 1929 prices. We're going to make this an inflation-adjusted analysis. So first off, yes, the portfolio still took a hit, but its maximum drop was 11.5% in 1932, during the 30s. In fact, it was worse in 1949 when inflation caused the value of the portfolio to drop after World War II. And finally, in 1956, the capital was recovered. Now remember, this is a portfolio where the individuals who own it, in this case, Jonathan and Martha, are using the income to live off. So let's look at the income. The income on this portfolio in constant dollars, in constant purchasing power, for the 27 years we're looking at, stayed within $1,000. It changed from $4,300 to $5,300, up and down a little bit over a period of 27 years. In other words, at no point were they really at any risk. The average income back then was $2,000 a year. So this portfolio did exactly what it was supposed to do, which basically effectively reduced their volatility by a lot and generated enough cash flow for them to retire. So this is a portfolio that went through the Great Depression, World War II, and the first 10 years of the Cold War. So let's take a look at what happens. Let's assume Jonathan and Martha are a little younger than they look in the picture. And they want to save for Clark's education, so they've decided they're just going to let the income get reinvested. How would that look if you're not essentially ready for retirement? Well, in this same 27-year period, your money quadruples in real terms for about a 5.3% after inflation rate of return. Far better than a balanced portfolio for the last 15 years, which is around 2%. And this, again, in an extraordinarily difficult period of time for any kind of investments. And maybe more impressively is this, is after 1956, for the last 60 years, if we took a look at the same portfolio and said, well, how did it do afterwards? I mean, it was 5.3% before. How did it do afterwards? Exactly the same. The return is not higher. And in fact, it's actually a bit more volatile over that same time frame. So, in other words, this is as close, in my mind, to a bulletproof portfolio design from a diversified perspective, from a cash flow perspective, because it's weathered all kinds of storms and been incredibly consistent in the long-term rates of return it generates. So let's take a look then sort of at the summary of where we stand. So the first thing is that we want to be tax effective in investing, and the fact is, in this environment, fortunately, we still can be. We want to make sure that our model has a diversified asset allocation, as Rob said, but also we focus on the cash flow it generates as well. We want to constantly rebalance, and we have to be willing and comfortable buying assets that in the moment are losing money. And finally, we need to look at investments where we are investing in things that are going well. We have to look for adding value. It's not going to be good enough in the real estate markets going forward to simply buy a property and stick it in a drawer and just collect the rents. More will have to be added in value to make the returns we'd like to make. So that kind of comes back to a more positive note. So maybe now that we've got through this, you can look at my situation and see that maybe I can actually move into the poo side of the equation and become Pooh Bear after all. So with that, what I'd like to do is thank you all for being here tonight.